Hey, I listen to Your Money or Wealth while doing laundry. Chooses Mick Ultra occasionally. I live in Palm Desert. Any financial or tax considerations if we decide to turn our Palm Desert condo into a rental property? It's currently our primary residence. So Bill writes in there, Big Al. So let's say I have a rental and I want to convert it to or it's a primary,
right?
Then I'm converting to a rental. Uh, this was a popular strategy that people would try to avoid the capital gains tax.
Sure.
And saying, hey, I have a rental property now, I'm going to live in it, and then I'm going to sell it and take the 121 tax exclusion and so on and so forth. So
right.
What?
So let's explain that. So if you sell your primary residence and if you lived in it 2 out of the last 5 years, you have to own it and live in it 2 out of the last 5 years. Then you get a $250,000 gain exclusion, which is $500,000 gain exclusion if you're married. So if you convert this property into a rental property, you basically have 3 years to have it be a rental, because then at that point, you're going to need to sell it. If in fact you are wanting to sell it to get that $250,000 or $500,000 exclusion. So that's a huge consideration there. But what you were alluding to, Joe, is some people actually, if the gain was big enough, they converted to a rental, they sold it within that 5-year period, and they took some of their gain off the table, $500,000 worth if they're married, and that was tax-free because of the exclusion. And then all the rest of the gain they deferred into another rental as a 1031 exchange. And it's not commonly known, but you can do both of those rules with a single property. That's a really clever rule. If you have a property with a big gain, you don't want to pay the tax currently, and you want to buy another property, you defer part of the gain into the other rental and take some off the table, just in terms of the exclusion on the principal residence.
Yeah, I guess, Bill, there's a lot of different, I guess, ideas and strategies in regards to, depends on what your goals are, again, right? But if it's your primary residence now, you're going to convert it to a condo and you want to sell it in a couple of years and get some rents, you could still take advantage of the 121 exclusion. If you're going to just convert it into a condo and rent it out for the next 20 years,
then you lose that exclusion.
Even though it started out as a primary?
Yes, unless you move back into it, which you could.
Yes. That's right.
In 20 years from now, you got to move back into it and then own and live in it for another 2 years. So that's possible. You still have depreciation recapture on the period of your rental, right? But that does work. If it was a residence first and you convert it to a principal residence, the rules are totally different. There's a pro rata amount of.
Well, no, what you said didn't make sense. You said if it was a principal residence that was converted to a principal residence.
Oh, if it was a rental property first that was converted to a principal residence, then that 2 out of 5 years, it can still work, but it's a prorated benefit. It's not the entire benefit.
Right. And that's based on some rule changes back in
like 2009 or something. Yeah.
So, all right. Well, yeah, you would still get some of the 121 exclusion, but not all.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.